All right, so what I wanted to talk to you guys about was why I chose to invest in commercial real estate in the first place. And as Jason had probably alluded to, the what happened was I sold a company. It was the third company I sold, and we had about a $75 million gain, and we needed a lot of tax sheltering, as you could imagine. And so, without further ado, I'd like to talk a little bit about the path forward so that you guys have a working understanding of what we're going to hit. We're going to talk a little bit about you guys and myself as investors. If everybody else could go on mute while I'm talking, I'd appreciate it, Jay. And then we're going to talk about the two basic investment choices that everybody has and how they compare. We're going to do a quick CRE 101 or 201, talk about the three ways that CRE creates wealth. And there's a fourth secret driver we'll talk about. We're going to show you an example to explain two types of real estate investors, and then explain how that applies to both active and passive investors. And we'll end with a quick discussion on 1031 and try to explain kind of what the options are for you guys going forward. So without further ado, let's begin talking a little bit about you and I. We all, or at least at some point, earned wages and owned practices or other businesses that produce profit. And in all of those endeavors, we had silent partners, Uncle Sam, and they're great. All they want to do is take their fair share, quote unquote. And then we all choose to invest with the capital that we have left over. And the government is nice enough to even allow us to pay a fairer share of our taxes. So as we progress down the path to completion here, I want to say that we really, at one level, only have two basic investment choices. So not investing is the same thing as investing in cash, if you think about it. And investing, which is everything else other than investing in cash, whether you're investing in stocks, bonds, or hard assets, which can be commercial real estate. It can also be commodities and futures and other investment vehicles. What we'd like to show you now is a comparison between the two. So the choice of not investing or investing in cash, a lot of people think, hey, you know, a dollar's worth a dollar, and as long as I hang on to my dollars, long ago, everybody used to stuff them under their mattress. And this graph shows, and some of you may have seen it in other places, it shows what's happened to the value of a dollar since 1913. And what it's basically saying on the left is that a dollar was worth a dollar. And if I asked you, how much would $1 million house have in 1913? You know, you're talking a Rockefeller level home. And then you bring it forward to today, and that same $1 million doesn't buy you the same thing. So investing in cash, you know, be it inflation or taxation, is a good way to end up with roughly 3% of your capital after 100 years. So now let's talk about investing in everything else, which is stocks, bonds, and hard assets, such as commercial real estate. We will start with stocks. So I've invested in pretty much everything. I've invested in crypto, stocks, derivatives, futures, foreign currency, residential rental real estate, Airbnb real estate, hotels, motels, office buildings, etc. What I did not enjoy when it came to the process of investing in stocks was, I thought, you know, when you have a huge exit, you're finally retired at a point where, you know, you kind of have the day as you would like it. But what I found myself doing was immersing myself into global macro trends and then doing technical and financial analysis on companies. And so it became a full-time job. Everybody who's out there doesn't know me. I'm an extroverted person, so I'm a people person. I like to be around other people. And I realized that I had gone from being an entrepreneur, surrounded by people I could talk to running spreadsheets and working alone. The other thing I didn't like, and I have to say that looking back, you like to see the gains, but I have seen gains and losses on my daily screen that were $1 million or more. And looking back, I think that a stoic approach where you're not excited or upset when you see those gains and losses is the best approach. But I'm kind of a lead with my heart kind of guy, and seeing large losses on the screen daily, updated every second, was just not something that worked well for my disposition. Might work well for some of yours, especially if you have a professional manager, but for myself, I didn't enjoy it. The other thing is I didn't want the market or a broker to control my money. High frequency trading, etc. I felt like the game was rigged against me. I felt like I was playing with professionals with much better hardware and much larger research staffs. So then you look to bonds, and I've invested in those as well. Definitely not as painful to watch, but for many income investors, and I'm sure some of you, the grass grows a little slow in the bond market for us. And we've had some recent activity that was a little exciting, but over the past 10, 20 years, it really hasn't been a good investment solution to grow wealth so that we can stop working and do what we enjoy. So that brings us to hard assets. Now, we didn't want this to go long. We could have talked about futures, we could have talked about commodities. The one thing I'll say is, with respect to the building that you're looking at, I'm sure there's asphalt in it, concrete, steel, glass, metal, etc. And so one of the things that I look at real estate as is a leveraged commodity investment where other parties will give you money to make investments to grow your wealth. And I know there's not going to be any more commodities, so I would say I'm a very long-term commodity bull. You remember I showed you what it was like investing in cash. I want to juxtapose this to what it's like to invest in property over time. So the red line is investing in cash, and it's basically, this one starts in 1922, the other one started in 1913. But then you see a property index, and it doesn't much matter whether it's in the United States or Australia or Russia. If you think about it, everything is denominated at some point in US dollars. So if you were to look at gold or other assets like oil and price those behave very differently from assets that are valued in fiat currency. And if you remember, I said, you're either choosing not to invest primarily or to invest. And if you choose not to invest, you're actually choosing to invest, but you're investing in the money printing fiat process that we've seen, especially recently with the COVID pandemic. So we're moving on along. We'll hit a very quick CRE 101. I know everybody's time is valuable, and we want to keep this fast-paced and entertaining. CRE basically has what I'll call five food groups: industrial, retail, office, multifamily, and hospitality. The point is not that any of you out there take notes on what all the examples are, but you just kind of recognize them and say, yeah, I know, I kind of get a Tesla plant, or I understand a mobile home park or a motel and how those are all different. So there are many more than five, especially as you get into the niches, which sometimes there are riches in, but these are the five primaries. The reason why real estate ends up at the top of my radar as an investment class, and always has since I've been very young, is the concept of leverage. Now, if you want your returns to go crazy, just take on 99% leverage. I would not recommend that anyone do that. I think it's important to have a prudent approach to leverage and to maintain cash reserves so that you can weather the storms if and when they come. There's been times when I thought things wouldn't go wrong and they did, and the opposite has happened. But leverage has many forms. It's financial, borrowing from banks, it's tax, it's people, interest rates, knowledge that you can accumulate or quote unquote borrow from us. So you go to a bank, that's the primary form of leverage that everybody is aware of. And there's a number of tax deductions, the primary deduction of which is depreciation. In some countries, depreciation and interest are not available to real estate investors, so we're lucky as Americans to have that valuable benefit. Moving down the path, there are three basic ways that commercial real estate increases or creates wealth. The first way is what everybody is comfortable with, which is cash flow. And if you're like me, cash flow is king. That's what I can count on. That's what I can live my life on. That's what I can maintain my family on. But the second thing is loan pay down. And this is where you're leveraging not only the financial institution, but your tenants, those people that are out there doing the hard work that they do every day and paying down the loan on your property. The third thing is appreciation. And I personally don't like PowerPoints that have a lot of moving parts, but I wanted to bring this in second and say, it's easy to look on a secular basis at stock market returns or at appreciation returns and say, hey, I think I've got this figured out. I have a 10 or a 20-year investment experience time horizon. I want you to think of appreciation as inflation. Obviously, we've been going through that a lot, residential rents, et cetera. But I want you to think of rising rents in a long-term commercial lease. And the opposite of inflation is actually currency depreciation. And so the reality is, since everything is priced in dollars, it's the fact that dollars go down in large part that makes things like real estate go up. And if you borrow the dollars, you're kind of on the same trade as the Fed. And so you're investing with the smart money, if you will. Let's see, I've got to go one more click here. Okay. So again, three ways to create wealth. I'll just summarize them: cash flow, paying down your loan. And I shouldn't say paying down your loan, your tenants paying down your loan, and then appreciation. Moving on down the path, there is a fourth commercial real estate wealth driver, also available in the residential space, and that is basic depreciation. So I really gave it a lot of thought, and I could do a very long webinar or multi-series webinar on depreciation. But in the commercial space, it's purchase price, which happens to include other closing costs, minus land, and more or less divided by 39. There's this concept of cost segregation. We're going to talk about bonus depreciation next. When they asked me to put this webinar on, I said, let's not talk all hoity-toity. Let's break it down and make sure everybody gets the basics, because if we don't have that, we can't build upon it in our own educational path. So cost segregation, kind of as you see here, this looks like a digital camera. It's basically just segregating things out into pieces. And so if you can't depreciate land, so the only thing you have left is the building. But if you think about it, wallpaper doesn't last that long. Neither does air conditioning units, neither do windows, neither does parking lots or outdoor landscaping or lighting. So what they do is they use what's known as the engineering method, and there are firms that specialize in this. I have done cost segregation studies I'm embarrassed to say, for approximately 30 years. I no longer do them, but I understand them very well. Cost segregation is not a one size fits all. As you could imagine, having a single tenant warehouse with a bunch of shelves in it doesn't have as much going on as a dental office, by way of example, or you know, a mobile home park with all the underwater plumbing, et cetera. So bonus depreciation. So I oftentimes hear people juxtapose accelerated depreciation, bonus depreciation, cost segregation. All cost segregation does is pull items out of the building and depreciate them over shorter lives. And if we didn't have the tax code that we had now, it still takes depreciation that's like this and makes it heavier in the first years. But what bonus depreciation does, everything under 20 years, you get to take 100% in year one. And you say, you know, Patrick, that's not true. You only get to take 60%. Okay, the bonus depreciation is 100%. The legislative sunset from the TCJA goes from 100% down to 0% in 2026. Will it be extended? No one knows. My secret guess is it probably will. I though do not make investment decisions by letting the tax tail wag the dog, so to speak. All right, well, our smiley face is progressing down the path. And now we're down to the, I don't know if they're drinking iced tea or if those are Long Island iced teas, but our passive investors on the sailing ship. What I'd like to do is I'd like to go full circle. And I know that we have some dentists on the call, and I was really happy to find a circle of chairs with a dental chair mixed in. I'd like to go back to the bonds example because I think it's going to help us understand some of the benefits of investing in real estate. So if anybody talks about math, it's time to go to sleep. I'm going to make it super, super simple. So it's a taxable bond. You have a 40% rate. Don't call it a taxable bond. Call it your W-2. Call it your profit from your business. So let's say that this income stream pays 6% pre-tax. So there's a math formula that looks complicated because it's algebra, but basically all it says is if you're bringing in 6% and you're going to send 40% to somebody else, you get to keep 60%. So 60% of 6% would be 3.6%. And then I'll make it even easier yet and say that if you were in a 40% tax bracket and somebody says, I have an investment for you that pays 6% and it's pre-tax, or I have one that pays 3.6%, it's after tax, they're the identical investment. Does anybody have questions on that, Tony?